Welcome back, everybody. I suggest we slowly get started. Good afternoon. I hope you all had a good lunch break, and welcome to our session on military spending. I suggest we don't lose time and get going straight away with our first presentation, which is by Ilyana Kuziemko from Princeton, and it's about revisiting military Keynesianism. So the stage is yours, and 20 minutes.
So if it's okay, I think I'll just keep seated as opposed to having to hold the microphone. Oh, I guess I'll sit a little bit closer here.
Oh, I think this mic is on. So
okay.
Like that. Yeah.
All right. So thank you so much for putting us on the program. Let me just make sure this works. Okay, here we go. It's a pleasure to be on the program. This is joint work with Suresh Naidu and Danny Honorato. Look for Danny on the job market in 2 years. And as was just introduced, the talk is Military Keynesianism, Labor Market and Political Effects of the Cold War. So states often claim that military spending creates jobs. It was not hard to find 3 examples in the last few years in news clippings, examples from the US, Russia, and Putin, and Germany. And so we're going to look back on this question of whether military spending creates jobs, whether that creates support for, military spending and intervention in the context of the U.S. Cold War. So as just a coincidence of timing, perhaps, when the U.S. was spending sustained 10% of its GDP on the military during the peak decades of the Cold War, this coincided with what we now think of as a golden age for the U.S. worker. This was, termed the Great Compression. We had I'm American, had very rapid GDP growth, but also very low levels of wage and income inequality, the lowest, that's ever been measured in the U.S. And as you can imagine, labor economists have, spent a lot of time thinking about the underlying explanations for this period, and I've listed a few of the ones that have been discussed the most on the slide. But what's interesting is that to date, the role of the Cold War, this 10% of military share of GDP, has not really been included in the sort of modern quantitative inequality literature. And I think it's surprising because it was talked about all the time contemporaneously. Like, you can't spend 10% of GDP and not have people discuss it. So here's just Joan Robinson, who comes, one of the original Keynesians, who says that prosperity in the U.S., she's writing in 1962, has been a byproduct of the Cold War, that 60% of gross investment is coming from the Department of Defense. Robert McNamara, who is the Department of Defense secretary for much of the 60s, really hated this idea, although he totally said, this is how we think about it, that the Pentagon should be a jobs program. And so he called the Pentagon a gigantic works progress administration, WPA, which was the program to give work to the unemployed during the Great Depression. But this idea that the only way we can really do government spending to sustain full employment is via war is an idea that at least goes back to Keynes in a 1933 letter to FDR. So we think of this as a forgotten explanation for the strong growth of sort of low-skill and blue-collar workers, wage growth during the decades that follow World War II. We should say this is not just spending that happened during hot wars, such as Korea and Vietnam. The goal of, stated in the National Security Council documents, was that we just have to always be ready. We're going to just have a lot of spending even in peacetime. And so the summary of the arguments in this paper, we're going to argue that procurement spending did indeed shift outward labor demand, especially for less skilled workers. So it kind of, did create jobs for blue-collar workers over the course of several decades. At the same time, labor supply contracted for sort of the same group, in this case, young men. I'm not going to go over the results of that part in the paper, but I'm happy to answer questions about it. So not only was labor demand shifting out, but you had this massive decrease in civilian labor supply because so many young men, even in peacetime, were working as active duty military. And then the final step, we're going to say this kind of did work to support, to keep support for military spending and for continuing the hot wars during the Cold War. Procurement seemed to increase support for hawkish foreign policy. So just to give you a sense of how big the numbers were, this is the defense share of GDP from 47 onward. The 1950s average was over 10%, and then looking at the 10 years after the Cold War, this falls quite significantly. And again, I'm not talking too much about this in the slides today, but just the massive share of young men that at any given moment were not in the civilian labor supply because they were active duty. So in the 1950s, at any given moment, 1/4 of men 18 to 24 were in the service, and that is a very, very small number today. So just quick overview of the results. We're going to isolate moments where procurement shifts geographically due to shifts in sort of military priorities or weapon systems. I'll go over the specific shifts in the subsequent slides. And for all of these episodes, we're going to find large increases in manufacturing employment. For most of these episodes, we're going to find increases in wages and decreases in inequality. And over the entire period, if we just pool and do a two-way fixed effects design, we estimate that this large decline that I just showed you in military spending accounts for 25 to 35% of the decline in manufacturing employment. So we think that's like a really important under-discussed factor in the decline in manufacturing, and it explains about 10% of the rise in the top 10 share of inequality measure. I'm just going to one slide on the labor supply. I'm happy to answer more questions, but I'm not going to talk more about it beyond this. As mentioned, this was a massive contraction of the labor supply of young men. We show that every time military needs increased, unemployment among those still in the civilian labor force goes down for this group. Another prediction that comes from this implicit labor supply model is that when the draft ends in 1973 and we see military service plummet, we should see rises in unemployment for young men. That's exactly what we find. And we argue that the end of the draft explains about 75% of this large increase in relative unemployment for young men in the 10 years after the draft. The politics of the Cold War is the last bit of this paper. We're going to show that state-level procurement is a strong predictor of support for the various hot wars. So this is Korea and Vietnam. If you were getting procurement money, you were more likely to tell Gallup that you supported the war continuing. Then we just think about who was in the coalition, not so much thinking about hot wars, but just generically who was arguing for more military spending. And it is a coalition mostly of Democratic voters, which at the time were the working class party, and in particular union members. Almost all of these major contracts were going to firms that had been organized by unions. And so this, again, sort of reflects some pocketbook models of voting. Okay, I'm going to go really quickly over the related work given the time constraints. There's obviously a literature thinking about military spending on the macroeconomy. We're going to be thinking much more about the distributional effects, thinking about inequality and wages, which sector does this hit manufacturing. We're also going to think, there's obviously a literature on the R&D effects of the Pentagon investing in research and development. We're going to be thinking about the non-R&D effects more. We're going to use the R&D spending as a placebo. The non-R&D spending is the vast majority of procurement spending. Even at its peak year in 1958, R&D accounted for no more than about 19% of total procurement, and in most years it was quite a bit less. So this really is where the money is going, and that's going to be our focus, which has not been so much the focus in the literature. And then finally, just to compare this to World War II, there's obviously a large and important literature on the lasting effects of World War II. Just to give you a sense, the Cold War did have elements of sort of the planned economy that World War II did, but it was more mild. So there is a large draft, but it's not anywhere close to the World War II draft. There are some price and wage controls, but not, an Office of Price Administration like we had during World War II. There were no budget deficits. So this was, we ran massive deficits during World War II. There's no real budget deficits during the peak decades of the Cold War. So it was a much more sustainable effort, but it was still a large effort, and there were many ways in which the economy still remained somewhat planned. Okay, it pains me to go over it so quickly because we put so much work trying to collect some new data. I'm happy to go back and talk about it, but I'm just going to mention it, when it appears in the results. But we did digitize a lot of historical data for this project. Okay, so this is sort of getting into the meat of the talk. We're going to think about moments when procurement, our argument is that, procurement money really did seem to create jobs, especially for blue collar workers. And we're going to sort of our identification for this argument is going to come from moments when the military has reasons where it's like shifting its weapons systems, and that's going to affect different states differently. So the period I'm going to talk the most about is the 1950s. Although 1950s and then the 1960s, I'm going to skip the rest in the interest of time. So after World War II, there really was this view that the U.S. could never take on the Red Army in conventional warfare. The U.S. had to move toward nuclear, toward missiles, more aircraft. The Korean War happens, and that's like a major reversion back to conventional war. The Korean War was fought very similarly in terms of weapon systems that World War II was. But then after Korea ends, it goes back to this like big transition. And the states that were going to benefit from this were very different than the states that had supported the procurement efforts during World War II in Korea. So mountain states, because they had much less population density, and they'd be good to be able to test missiles, to test bombs. Cape Canaveral in Florida has this geographic perfection for missiles. It's surrounded by water. So these states, and this is well documented in military communications and memos, were going to be the winners. And the Pentagon is like really blunt about, there's going to be a lot of losers in this transition. So this is just one of the documents, just showing this really abrupt shift toward missiles. As you can see, the three bars, the first is World War II, the second is Korea, and the third is just fiscal year 1961. If you just look at missiles, they were essentially never part of the story in the first two episodes, but they are over 1/3 of everything the military produces by 1961. Oh, sorry, and you could just see the corresponding decline in the last set of bars of just conventional items. And these were, sort of produced in the industrial heartland previously. As you can see, if you just look at procurement, you look at the winners and losers. So here we're going to say, all the money that was spent under New Look, that was the Eisenhower Doctrine, minus all the money spent in your state annually during Korea. That just happens to be the first 3 years of our data, but we think it reflects how the military was procurement goods even before that. The winners are exactly the states I suggested, and the losers are the sort of industrial upper Midwest and Northeast. So we're going to use this measure. We're going to standardize it so it's mean 0 and standard deviation 1. So this is kind of just mechanical. I've identified winners and losers, and now I'm just saying, how did the money shift between winners and losers? So by construction, it's going to show a shift. What is not by construction is just how quickly it happens. So here you can just look at raw means. Everything here is log procurement dollars normalized by the state's GDP. You could normalize by population. You could not normalize at all. It all looks, very similar. You can see, all the states in the green and the blue, these are the losers, or the medium sort of in between. They go into, very rapid demobilization after Korea. But the winner states, the missile states, they're like continuing at sort of a full mobilization pace even after Korea. You can see this here as an event study, and just to give you some sense of magnitudes, again, everything here is standardized, so you can think about a winner as like 1.5 standard deviations above mean, a loser as 1.5 below, and so I think an easy way is just to sort of multiply these things by 3. And so you can see, a typical winner versus a typical loser. The winner is getting about 200 log points of procurement relative to the loser. So it's a very big, and again, it was talked about all the time. This was not something people didn't notice. Okay, so now we're going to look downstream. These are manufacturing employment per capita. Here I'm showing you the raw means if you prefer to see them, but the event study analysis, the event study is a straightforward, we're using that continuous measure, interacting it with year fixed effects. The blue is just the sort of baseline state and year fixed effects controls. We sort of prefer the red, which is letting regions have their own time fixed effects, arbitrarily, whatever trend they want to follow. So if you look at the red, how to interpret this is, again, a winner state is getting about 14 log points of manufacturing employment per capita relative to a loser state. Here, everything is per capita. If you do it not per capita, you get mildly larger results, suggesting there is some migration response, but it's only about 5% bigger. So I think in this short run window that we're looking at, migration is not going to be a major factor, but you do get slightly bigger results. Of course, one concern you might have looking at this manufacturing employment is that actually the winner states are just reshuffling, right? People had other well-paying jobs in other sectors. The manufacturing comes in. And we actually, don't see any real increase in sort of the good jobs provided by this shock. So what's nice about this period is that there is a concept of covered employment. So covered employment back then meant you were covered by the unemployment insurance system, and that excluded very low-paying semi-informal work, such as being a farm laborer or a domestic worker. So covered employment was like really good measure back then of having a good job. As you can see, the effects are even larger. So it doesn't look like manufacturing was just reshuffling people among a set of good jobs. If anything, there were positive spillovers. Okay, so those were the employment results. Our argument is that you're going up. The labor demand curve is shifting outward, so we should see some wage effects as well. Very quickly, we do. I have so little time, so I'm going to just show you very quickly. Wages also seem to rise, consistent with labor demand shifting out, and inequality seems to decline. So these are tax-based measures of inequality. The top 10 share I think people are familiar with. This one on the left is just the share of people in the state earning enough to have to pay federal tax. So it's a measure of getting people above a certain threshold at the bottom. So it's decreasing with inequality. Okay, so we're going to very quickly go on to the next episode. This is the 1960s. A lot is going on. There's budget cuts during McNamara. As you might remember, he was very skeptical of spending. All that gets reversed under Vietnam. What's cool about this period is that we were able to find data that breaks down state procurement into R&D and non-R&D. We don't have it before 1958. So now we're just going to do a horse race in this period. Was this coming from the R&D money, which would be weird for our theory, or is it coming from the non-R&D? So I'm just going to show you a two-way fixed effects horse race for this period. You can look at the top row. That's kind of just showing that we're getting very similar results as we did with the event studies in Vietnam. Here, I'm not breaking down the spending. I'm just showing you the same spending measure that we had earlier. But as you can see, the sort of employment and especially the wage and inequality results really load on that non-R&D. And so, it really depends on what the kind of spending your state is getting, whether it's having this sort of blue collar, good for the blue collar workers effect. I'm going to skip this because I've already said it in the intro. This is just our estimate. We do a very simple back of the envelope. How much could this really explain in terms of the decline in manufacturing and the rise in inequality? And these are just the exercises that I already mentioned in the intro. So we think 25 to 35% explanatory power for the decline in manufacturing and about 8 to 10% for the rise in inequality. And just last thing, if you're just worried, all of this is like beggar thy neighbor. States are getting some money, other states aren't. This is only a time series analysis, but when we do a time series analysis, we just take out a linear trend. We wind up getting very similar estimates. And if you even look, I had never noticed this until I put it together, but inequality starts rising right after World War II. It's sort of, we think about the Great Compression as after World War II, inequality is super low. Inequality is just right back up beginning in 1945-46. And then Cold War spending happens, and then Korea happens, and we never really look back. And inequality is again sort of bullied back down. I mean, that's one interpretation, but it's nice for us, to think that to see that these very simple aggregate time series regressions are giving us coefficients that are actually pretty similar to the more careful event study, state-by-state work. Okay, I skipped that, and now I can have 2 minutes on politics. Okay, so we're wondering, did this spending kind of create, manufacturer consent in the Chomsky sense? So we're gonna first, I'm gonna show you just one graph since I have so little time. So here, if you can see, we sort of show this holds for Korea and Vietnam. But what's nice about Korea is that there's this little period before there's any procurement spending. So North invades South, that's a surprise to the US and to the CIA. And then there's this period of how should we respond? And as you can see from this graph, there's no real procurement spending until January 51. But Gallup is asking everybody, what should we do? What should we do? This is a major event. So we have a bunch of data that's happening. People are asking what we should do about Korea, but there's been no spending yet. And as you can see, like the initial opinion about whether to intervene in Korea, first of all, it's very popular, has no relation to the eventual procurement spending you're going to enjoy. In fact, it's slightly negative. But once the war drags on, and once the spigot opens and the procurement money is really flowing, it is those states that are getting the actual money that are still supporting this war even when it's a stalemate and very unpopular. So it doesn't seem like there's anything special about these states in terms of their view about democracy on the Korean Peninsula or just their generic hawkishness, but it seems like it really, you had to turn the spigot on for them to actually change their opinion. And then the final graph, two last tables I'll show you. This is just showing overall sort of the political coalition that supported military spending and hawkish foreign policy. And as I said, the unions really do seem to play a role here. Unions are very big proponents of the Cold War in the US. The AFL-CIO literally works with the CIA to help create unrest for Allende in Chile. So, I think maybe different than unions in the US, in Europe, the AFL-CIO, the union organization in the US, was very pro-Cold War and very pro-military spending and supported the various interventions. Interestingly, the center-left in Europe is very different during this period. I'll leave you, I find this fascinating. It's not a major part of the paper. I think we might have even cut it. But because I'm here among Europeans, I wanted to bring it back. Whatever it is about the left and center-left that were so supportive of the military-industrial complex in the US, of hawkish foreign policy, does not seem to be the case in the countries we could find data. And these countries also have, large military budgets at the time. So it's just sort of an interesting puzzle. We have theories, but I won't share them right now. Okay, the last thing I want to say, sorry, one last. Okay. There's a lot of talk about a new Cold War. I think it's going to be probably pitched as a jobs program, as good for blue-collar workers, maybe. But I think there's sort of two things to think about that make me hesitate. First of all, it's a very different labor market institution in the US. There's essentially no private sector unionization, whereas, as I said, the key contractors of the 1950s and 60s were unionized. So that's one. And two, today's procurement is much more R&D heavy. And as you saw, those really didn't have helpful effects for low-skilled workers. The last thing I want to say is, it's always dangerous when you're saying this is the way we're going to help the working class, is spending military money. The Cold War was not cold outside of Europe and the US. Many people died in Asia, Africa, and Latin America in proxy wars. And even for those people in the first world, they lived under incredible risk during this time. So just a little, to put all that in perspective, there are some major concerns as well using military spending for job creation.
Okay, thank you very much, and we'll continue with the discussion. You can either sit or you can also stand. How you?
Either way, yes. Just need the slides.
Yeah.
Great. Well, thanks. I'm really happy that I was assigned this paper because I really loved reading it, and I think all of you should, because in the 20 minutes. Ilyana couldn't do justice to just how much detail and depth and historical analysis and empirical analysis there is in the paper. So really, it really is a paper that you should not just hear the presentation. You should also don't just see the movie, read the book too. So it is a very comprehensive study of the U.S. labor market in the Cold War. I think Ilyana explained it, but it's the Cold War defense procurement increased wages, lowered CEO compensation, you didn't have time to show that, lowered the top 10% income share, and created a political base that supported the military-industrial complex. So my job is, I guess, not to be just a cheerleader, so I'm going to make some comments which I hope will be constructive and useful to improve the paper. So the first comment is going to be the cheap and easy comment on identification. So the new look, the move to missile defense, is a very credible exogenous instrument to shifting of procurement across states. And so I really, really buy those results. Once we go to kind of the full panel regression, which you didn't have that much time to show, then it becomes a question of why are certain states getting procurement contracts. Clearly, the government is not randomly assigning procurement contracts, probably going for places where they see potential productivity growth. Maybe they're even going to labor markets that are weak. There's some lobbying. You know, Boeing has plants in 50 states for lobbying reasons. And so, you know, there's some strategic aspects here. It can't be viewed as entirely random. Fortunately, there are kind of some, I think, good solutions to this. So one self-serving suggestion is in my 2024 paper on World War II, just applying this to your context, what you could do is have a shift share that is basically doing what you did in the event study, but doing for the whole panel. That is, looking at the national movements between missile defense and air aviation and other things, and loading those national trends on states based on their comparative advantage. I'll show you in a moment how I do that in my paper. Cantor and Wally have, which you mentioned, have a different approach, which is to look at what the Soviets are doing and thinking about this as a competition. So kind of the exogeneity is the Soviets pull ahead on something, and you have a shift of procurement in a certain way. So this, for example, is in my paper, production of different aircraft types during World War II, and I go into a lot of detail in my paper of why these shifts are plausibly exogenous in these broad categories. For example, if you look right here, these are bomber aircraft, and this is the Pearl Harbor, the attack on Pearl Harbor. So you kind of see these exogenous shocks shifting procurement across states. The second comment is you can think about this as a missing intercept question, but I would just more broadly frame this of what is happening in the rest of the economy. So here's kind of a stylized example. You have two states, Florida and Illinois. There are workers and capitalists in these states, and the government comes and says, let's build Cape Canaveral, let's spend in Florida. Okay, great. The workers in Florida are better off in absolute terms, and also in relative terms relative to Illinois. But here's the thing. The capitalists profiting from this are not in Florida necessarily. They might be in Illinois. They might be in New York. They might, heck, they might be in London. And so now the capitalists could be, this could be the capitalists being enriched by this. And in fact, the causal effect of the spending is to increase inequality. But you would see in a two-way fixed effects regression that workers are both are better off and inequality has declined in Florida relative to Illinois because, again, this is kind of an intercept problem. The capitalists are everywhere. The workers are tied to their specific jobs. This is not, crazy talk. I mean, if you look at the labor share of income during this period, it's pretty stable. So we would think, based on your mechanism, that there would be this massive increase in the labor share. We don't really see, actually, the labor share starts to decline throughout this period. Another thing is to think about the Acemoglu and Restrepo type of story, that if you're creating a tight labor market in a certain industry, there might be substitution to capital, and then indeed these monopoly figures get richer. And then the third thing is there's some, in the introduction of the paper, there was some discussion about the potential mechanisms here, but I think that more could be done both empirically and if not, at least kind of descriptively. What actually do you have in mind is going on here? In a microeconomic sense, it's pretty simple. You increase demand for labor, both quantities and prices of labor go up. So that's very simple. But how do you think about this as a general equilibrium phenomenon? It would be worthwhile having some discussion of this. So there are two ways to view this. One is that you view this as some kind of industrial policy, so that actually somehow this procurement, the government has some magic trick to increase the size of the pie. This is not coming at one at the expense of the other, but the pie gets bigger. But most of the stories we have about that really have to do with these type of R&D externalities, which you're kind of excluding from the discussion. So the question is, what is the other magic trick that the government has that the private sector wasn't able to do without its assistance? One possible thing is that there's a human capital accumulation, that these secure jobs, partly because of unionization, partly because of the nature of the jobs, are more secure. You accumulate more human capital, and I have a project in progress, maybe next Geoeconomics conference I'll present it, on exactly how defense spending has improved human capital. The other type of story is that the pie does not get bigger as a result of the spending, and I think this is kind of the flavor of what you're getting at, but this somehow is redistributing from capital to labor. And that, I think, is very plausible, that the government has bargaining power. It can bargain lower markups, so we see kind of the profit share going down, and the labor share as a result goes up. I think it's an interesting question of why these defense companies were among the most profitable companies in the US at the time. So if the profit share, we don't know what the counterfactual, but if the profit share is really being compressed here because of government contracting, why was sort of Boeing one of the major, of the nifty 50 that every broker wanted to hold in their portfolio? Lockheed, these would be kind of classical firms you wanted to own because the profits the profit rates were so high. So ultimately, I kind of believe the stories you're telling, but I think kind of fleshing out why you think they should be happening in equilibrium would really kind of just add flavor and credibility to your story. So that's it. But great paper.
So thank you very much. Do you want to comment right away on these, or should we collect?
I'll comment quickly. Just
okay, great, and then we can collect the other questions afterwards. Okay.
So I feel like these comments are inviting me to get uncomfortably close to macro. Sort of don't.
I was quite explicitly pushing.
So I'm here now, way over my skis. So yeah, we're there's definitely a sense that all else equal, the contracts were actually encouraged to go to labor surplus areas. So these were places that had high unemployment rates. I don't know to the extent this was like a tiebreaker. There were also incentives to go to small business. So there certainly was a sense that like these the political economy of this was not lost on the players at the time. Okay, so if I'm going to just totally again go out over my skis in terms of did this increase the pie? Was it just redistribution? I guess I would. We don't have the goods on this at all, but just sort of speculating. I think there's an argument that full employment creates some of its own synergies and production. And there's, if you go back to Kalecki, there's definitely a sense that capitalists don't want full employment, even though it would benefit all of us. They lose control over the workplace, et cetera. I think that's one totally left wing. We don't have the evidence for it, but I would just add that to the ways in which this might be playing out, sort of add that to the slides. But the points you bring up in the slides are definitely, again, if I were more equipped as a macroeconomist, but we probably need to do a bit more even. We can't just cry out, oh, I'm a labor economist, don't bother me. And I guess the one thing I would say about missing intercept, and this is kind of lame, but you do see the time series. Inequality does fall, whenever you get a spike in the military share. So yes, we know we have a missing intercept problem. It's a classic setup for having a missing intercept problem. This also, to some extent, how much lower could inequality have gone? How much faster could the U.S. have this was, again, these are just arguing from time series, but we think there's something to be learned from that. But thank you so much for the thoughtful comments, and I'll ask you to send them to me later.
Okay, great. Then let's open the floor, and if there are any questions from the audience, we have a microphone over there. So, in the back, over there.
Hi, Ilyana.
Hi.
I have to come to Paris to ask you a question, even though I see
I know. We're in different buildings.
I know. Ethan Kapstein from Princeton. Just remind me, your time series is what period? What
So
do you
we do it either with or without World War II. It is so if you want to do it from World War II, I believe it's 1940 until 10 years. We do 10 years after the Cold War, so like 1999 or 2000.
Okay, so I'm just.
And then we also exclude World War II when we show it doesn't matter.
Right. So you had kind of suggested that there was a secular trend with the introduction of missiles and the shift away from, tanks and so on. But in 1967, I think, we introduced what was called flexible response. So
No, that's earlier. That's Kennedy.
Earlier. All right.
Yeah.
So
Flexible
what was
response.
the-
Yes. So flexible response is Kennedy. So Kennedy had a different doctrine than Eisenhower, and Kennedy felt we couldn't just work on deterrence. We were going to fight what he called brush wars. And so yes, even by 1961, I mean, I went so quickly, but missile research goes down under Kennedy.
Right.
Even though ironically he had run on a missile gap.
Yeah.
So
Okay.
yeah, flexible response is like 1961 is Kennedy.
Okay, it would be interesting when you actually see that reflected in the
you
procurement.
see
You're saying
that-
already in 61.
I mean, you see the decline, again, I went so quickly, but the decline in the decline in R&D begins, there's a real decline in R&D spending in the early Kennedy years, and then Vietnam just disrupts everything. So I can do this. Here you go. So these were the sort of Kennedy-McNamara budget cuts. Remember, a fiscal year is often, like Kennedy's budget often doesn't get implemented until the next year.
Right.
But so you have in this graph, the blue is the RD, and you can see that flexible response begins. Again, these are fiscal years, but it's announced, I believe, in 1961.
Okay.
And yes, it was a return to a bit more conventional. Yeah.
Yeah, so I was just trying to isolate the effects of that on the trends that you're seeing.
And I guess, a little bit just pointing to this graph, again, it's sort of cheap, but, there are these sort of just, every administration kind of has its own agenda, and to the extent that, there's just parts of this that are random or breaks in trends, we sort of think there's some, especially when we're able to control separately for RD, we think it's a relatively demanding test, even though it's not a proper instrument. Yeah. Anyhow, sorry.
No, so I wanted, then the other, uptick I was going to ask you about was the Reagan period.
Yes. Sorry, I didn't get a chance to talk about it. So you can, I think I just deleted these. So I have a graph like this. It's not Reagan, first of all. It's Carter-Reagan. Okay. So the end of détente, people sort of date it to 1978, 79. You see under Carter budgets, a large increase in conventional, not so much RD. And then you see once Reagan gets in, the conventional increases still, but then the RD catches up. And during the Reagan period, Carter-Reagan, we do not find effects on inequality. We find the same employment effects. I mean, we suspect it's just like the Volcker shock is happening. There's so much slack to the labor market that even if you have jobs, you have no ability to bargain for higher wages. But we find no wage effects and no inequality effects during the Carter-Reagan boom. And we have a whole section looking at sort of heterogeneity of these effects. So like procurement dollars, the ideal experiment, you drop procurement dollars in a place that have pro-worker institutions, you drop a procurement dollar in a place that has not pro-worker. And in the paper we show that you do find stronger effects. I mean, it's not well identified. And I think the 1980s was just not a pro-worker moment. And so while we found the employment effects, there's just no effects on wages or inequality. Yeah.
Thanks.
Yeah, there's another question. Two even. Maybe we collect these. Oh, you can also, yeah.
Amazing paper. I was curious about the position of the unions across Atlantic. Do you have a story for that? What?
Oh my God, I could talk about this for an hour. I mean, in 1947, Taft-Hartley passes in the U.S. This is a very anti-union bill. One of the provisions was that anyone with like a sniff of communism in their past had to be kicked out of the unions. And so, from 1947 onward, even relatively left-wing unions, such as the United Auto Workers, which is probably the biggest left-wing union, is officially anti-communist and is officially gonna just sign up with the Cold War. This begins to break down in Vietnam. So Walter Reuther, who's the head of the UAW, at some point says he no longer supports Vietnam, but the AFL-CIO, the umbrella organization, always supported Vietnam. And I think, the jobs were good. I mean, they totally understood that. And, they had this view that you could, trade unionism does not mean communism, and they were totally part of the anti-communist movement. And yeah. And I'd love to know a little bit more in Europe. I find that sort of non-result or the opposite result in Europe to be very interesting. I suspect, the US doesn't have this old military tradition of like military families that were involved in conservative politics the way I envision some of the, I don't have the data. And so I think there's just, again, this idea that you could be on the left and center left and be the more hawkish, maybe is just uniquely American in this time.
Okay, and then the last question.
Just question on procurement practices. Have they changed over time? Can you say anything about what was effective, what was more effective? I guess in Europe we're just finding out that increasing the euro amounts and allocating them
To what goal? Effective in what goal?
I don't know. Maybe do they move to more capacity planning? Is there ways, procurement practices that help crowd in the private sector more?
Interesting.
Is there anything that changes over time or something we can learn
this
from?
certainly, again, it sort of really depends on your goal. One part of the paper we, again, not super identified, just do the sort of two-way fixed effects regression and stratify it by like things we think might be interesting. And again, we find the larger effects, at least on workers and wages, are in these places where the money is going and there's like pro-worker institutions. So if like your goal is like you're the, a union member, like you want the interaction between the dollars and the institutions. What else can I say to that? The goal of like producing employment is probably not, the goal of like technocrats in Europe thinking about how best to integrate their forces and be more effective. So this paper is, I don't know.
Were they just giving out contracts?
Yes, these were cost plus. These were cost plus contracts.
That's what I mean. Like, how did they organize?
Yes, so
the
these
whole
were mostly cost plus contracts. And something I wanted to say about like where are the capitalists, what's the counterfactual? A lot of these companies, like the counterfactual for these companies, is that they wouldn't exist, right? So GE, even Boeing, do not exist but for the government. They're 80% of the revenue is going to the government. So I don't even know what the counterfactual is. They just don't exist. The older companies, the World War II and Korea companies, I'm not really answering your question, I'm just sort of spouting things I know, were consumer facing. So like, interestingly, we were reading the sort of company reports of GM as the Korean War starts. And they're like, this is a bummer. Like, we make more money selling to consumers. We're going to do our part. It was very patriotic, anti-communist. But the companies that have, again, this was a booming time in America, like consumers, it was great to be consumer facing. But then the sort of companies that really grow out of the missile age, and they just become the main contractors. GM is a small player after Korea forever. They really are only selling to the government. I think there's definitely a sense that the government didn't do enough to the profits were probably too high. But that was sort of a decision the government made because they really didn't have any other sales.
Okay, great. Thank you very much for the session. Let's start with the second presentation by Matthias Thoenig. It's about the military Taylor rule. You can either use this microphone, you can also use like this one. Whichever you prefer. Quickly have to switch it on.
Okay, so thanks for giving me the opportunity to present this paper. It's the first presentation of the paper. And I'm insisting on the fact that it's very preliminary. In particular, the empirical results are not fully stabilized. And I think even the title is not fully stabilized. So please let me introduce to you my co-authors, Jonathan and Christophe, who are in the room. Okay, so basically, we can start with, a look at the cumulative return of the Rheinmetall stock. Rheinmetall is one of the main manufacturer of weaponry in Europe. And so what you see, it has, just after the Russian invasion of Ukraine, you know, the cumulative went up to 100%, right? So that suggests that, you know, and so why is it important? Well, because we see the stock as a forward indicator of future military spending, right? And so big increase in the stock return as perception that the risk of war is increasing. But what is even more striking is that this is the Russian invasion. Look in February 2025, that the speech of J.D. Vance at the Munich Security Conference that infuriated the Europeans who interpreted, you know, this speech as a strategic disengagement of the US from Europe, and in particular as a reshuffling of alliance between European countries and the US. And look at the evolution of the stock price after the speech. And so this suggests that this forward indicator of future public spending reacts to a perception that the alliance network will be reshuffled. Okay? So that's just an illustration of what we all know in this room, which is we are now testimonying a new era of military spending. That, for example, you know, the NATO spending targets has changed last June from 2% of GDP to 3.5% of GDP, which amounts to, you know, $1.5 US trillion annually more additional military build-up. So it's a massive increase in military build-up. And we know from history, you know, that this type of shock, military-induced shock, you know, have transformative consequences on state capacity. You know, that's what we observed in the 16th, 17th, 18th century in Western Europe. And that's what we already observe, if you think of it, in Germany, which, you know, made an amendment to its constitution last spring in order to release the debt brake. Okay. So now the question we want to answer in this paper is, how much should those countries spend actually on defense? And we perceive that, we think that there is a lack of evidence-based quantitative studies here that can guide the policy, and that many decisions so far rely, you know, on discretionary ad hoc spending rules or policy targets. So we propose a military spending rule, MSR, which is a parsimonious, model-based empirical rule in the spirit of the Taylor 93 rule, in the spirit. But the main departure from the Taylor rule is that here it's key to account for strategic interactions, in the sense that the military spending of your rivals and allies should affect your military rule, but reversely, your military rule should affect the military rule of your allies and rivals. Okay, so we need to account for those strategic interactions. And at the end, we solve the model. The model can be quite simply put to the data, and we end up with a regression design where we have 4 variables that can explain up to 80–90% of all variations in military spending that have been observed across 60 countries since 1870. Okay, so it seems that the explanatory power of those 4 variables is quite high. Good. So let me skip the related literature, which is quite big actually, and jump straight to into the model. Okay, so we model an arms race between N countries that are populated each by LIT workers, and those countries can be heterogeneous in population size, heterogeneous in technology, frontier, etc., in military capacity as well. So at day T0, you know, there is an exogenous geopolitical network of alliances and rivalries that built up, with AIJ plus equal 1, meaning that there is an alliance between IAJ minus equal 1, meaning that there is rivalry, and 0 otherwise. And then at period T equal 1 and onward, there is a repeated stage game, such as in each period, first, you know, each country has to set its military spending under a perceived war risk omega IT. Okay, so there is a time to build your military capacity if you want. And so military spending is simply equal to the number of workers allocated to the military sector times the productivity of the military sector. Then at stage 2, state of nature is revealed, it's peace of war, and this will impact the supply of equipped labor here. Okay, so the supply of equipped labor is equal to LIT if it's peace, it's equal to G times LIT if it's war and country I is victorious. So G can be actually positive, larger than 1, or smaller than 1, meaning that in case of victory at war, maybe the country is better off, but not necessarily. What is key here is that if there is war and defeat, then for sure the country I is worse off, okay? Such as actually its equipped labor supply is equal to its population times G minus delta. So delta is the discrepancy between, you know, victory at war and defeat at war, okay? And then at the period T state 3, consumption takes place, such as actually the population that has not been, or the workforce that has not been allocated to the military sector will produce consumption goods with a productivity AC, and the consumers will enjoy the consumption, okay? And so the ratio of the productivity in the civilian sector and the military sector, A, will capture the relative cost of military spending in terms of consumption. Okay, good. So now, we need to model the fortunes of war. We use a standard contest success function, so that the probability of that I wins is the ratio of the military power, mu like military, of I with respect to the military power of all the other countries in the world, very standard. We depart from the literature here by modeling alliances and rivalries within the military. And we do that by assuming that the military power of I is equal to the military spending of I plus beta times the total military spending of its ally minus gamma times the total military spending of its rivals. So beta and gamma are key, are security spillovers, are key parameters, you know, for the rule ultimately. We'll see that. So big chunk of the empirical analysis is to estimate how strong are those two security spillovers. Okay, and then the last term is our military shifters, you know, that are unobserved or observed, and that allows you to transform this thing into an econometric regression. Anyway, okay, so let's think of what are the predetermined military spending here. We assume full depreciation of military capacity between periods, so it's not crucial, but it's a kind of long-run view, and such as actually that's the objective function of the country I when it chooses its level of military spending. So basically, you can rearrange those terms, and what you get is that the objective function is given by the contest success function times what we call geopolitical balance, which is what is at stake with war, and that depends on the probability of war, the destruction cost you endure in case of defeat, times your peacetime GDP. Okay, so this is geopolitical balance. Net of the cost of military spending that captures the well-known guns versus butter trade-off in military spending. Okay, and so the question what we want to solve is what's the Nash equilibrium at the end? Okay, so this is the first order condition of this problem. I go fast on that, but simply tells you, given the military spending of other countries in the world, what M star is the best response function of I. And what you see is that those are the marginal benefits. This is the marginal cost. Marginal cost is simply the relative cost of military equipment with respect to consumption. What is more interesting are the marginal benefits. The marginal benefits increase with geopolitical balance. Remember, geopolitical balance is perceived probability of war times destruction cost times peacetime GDP. Okay, that's quite intuitive. What is new here is that this HI parameter plays a big role here. We call it the local hostility towards I, and it's a network-based measure of how many rivals versus allies country I is having in this network. Okay, so that's and what you see is that when the number of rivals of I increase, weighted by the security spillover, H goes up, and so then you want the marginal benefit of spending on military increases. Okay, reversely, when you have more allies, your marginal benefit of investing into military capacity goes down. Okay, so that behaves quite intuitively. So this is a system of n first order condition and unknown, and unknown. So technically, you could solve it and get the Nash equilibrium. It's a very nonlinear system, as you can see. However, we can characterize it in reduced form, in closed form. Okay, and it's important to have a closed form characterization because then you can really interpret the model when you go to the data in a very transparent way. Okay, so that's it's not just a geeky view of the model. It's really important for interpreting the rule. Okay, so this is a theoretical best response function that tells you what is the best response of I when the allies and rivals of I also are at the Nash. And what you see is that this term represents the Nash military power, mu star. It's really your long-run policy target in terms of military power. And in order to achieve this mu star, given the spending of your allies and rivals, this is what you have to do. Okay, so that's the characterization of the best response. And so the identifying assumptions here is that you observe the geopolitical network, you observe all military spendings of the allies, the rivals, and yourself. Those things go into the residual, and you assume that geopolitical balance of IT is given by the peacetime GDP of I in year T times the unobserved perceived war risk by I and the perceived destruction or the expected destruction. Okay. So you can transform this theoretical equation into this empirical military spending rule that will tell you that military spending depends on the total military spending of your allies, of your rivals, of the average GDP in the world with this positive coefficient. It captures the, theoretically it means that when the world becomes richer, the average spending, military spending or military tensions increase actually, and so that's why you want to increase your spending as well. And the last term is a differential between the difference between your GDP and the world average GDP. And it also loads with a positive coefficient. I will tell you more on this coefficient. All those coefficients have a structural interpretation, such as when you estimate a model, you can recover all the underlying parameters. You can also do some model testing, and you can also simulate counterfactual simulations. In particular, the model tells you that this regression coefficient captures the security spillover of alliance should be negative. That one should be positive, security spillover attached to rivalries. And there is a model implied conditions that allows you to test the model that tells you that actually, if you regroup, that's what we're going to do in the econometric specification, if you regroup GDP average into a single coefficient, theta minus lambda should be actually not negative. Okay, good. So you see, we can estimate that with standard OLS. However, causal inference is problematic because we know from the network literature, that you have to deal with homophily. For example, democracies tend to be allied with democracy, and maybe they are less prone to go at war. Okay, so that you also have to deal with reflection problem, which is my military spending depends on yours, and which depends on mine. Okay, so you need to instrument those things, and so we need to find exogenous variations in the total spending of your allies and rivals that do not influence your military spending directly. Okay, that we go for financial windfalls impacting your allies and rivals. And you can also use financial windfalls impacting the rivals of your allies, the allies of your rivals. Okay, good. Now, last word on the factor loading, which is key, right? How much military spending loads on your own GDP. That's key for policy. It has a straightforward interpretation based on in this model. It tells you that the GDP, so the factor loading of military spending on GDP should increase with local hostility. The more allies you have, the less you want to load your military spending on your GDP. The more rivals you have, the more you want to load. It also increases with the war risk, right? If Germany expects that now the war risk in Europe increases, and Germany should load more its military spending on GDP. Okay, and then very naturally, you see, if you are in a wartime versus peacetime, your military spending should change. Why? Because in peacetime, you are under the shadow of the conflict risk, right? Whereas when you are at war, you know that you are at war. So meaning that the parameter omega I switch from 2 to 1. Okay, and so you would expect naturally that the factor loading of military spending on GDP increase in wartime. That's very intuitive, but that comes from the model very naturally. Okay, so we estimate this model. I go fast. So in a yearly panel of 60 countries, 2017, 2023, military expenditure comes from the correlates of war projects. CEPR, GDP comes from a macro history database. Financial windfall. Okay, windfall. Actually, we need to use the Harvard Atlas of Economic Complexity. I will show you why. to compute it, and so we restrict the IV estimation on this subsample. The data on alliances come from ATOP, rivalries from Thomson. Okay, so basically the network, the average number of allied in the network for each country is 17, and the average and rival is just 1. Okay, so way more alliances and rivalries are observed. This is a rival network in 2018 in our sample. And the sample is quite stable from 1 year to the other. Those are transition matrix in terms of alliances and rivalries, and you see that loads quite heavily on the diagonal, meaning that it's super stable. Okay, so what we estimate now the military spending on TMA, TMR. So what could I say here? Is that well, that's what we do. Okay, so this is the first descriptive OLS table. First, you see that this is military spending on it loads negatively as expected on allied spending, positively on rival spending, and positively on GDP. So you see the loading on GDP is around 3% actually. And then you add average GDP in your sample. Remember the theory tells you it should be negative, it is, and the theory tells you that this factor loading on GDP should be larger than on the average GDP, which is also the case. Okay? Then instead of having stable loading, you allow for country-specific loading, and that's what we do in the last column, and the results make sense. Quickly, with only those 4 variables, R² is at 63. If you allow for flexible coefficients that are country-specific, you go up to 86. And actually, you can use this model to predict what should have been, the model predicted in dashed red, military spending across the full sample. In blue, this is the realization. And so you see that the fit is quite good, actually. Something I forgot to mention is that this one is based on where you also interact in war with you allow the GDP loading to be different in peacetime and wartime. If you can go for decade level regression, the results go through, more in the spirit of the model with full depreciation. And if you are a bit worried that all the action is actually driven by the long-run increase of GDP, you can estimate the model in terms of share of GDP, percentage share of military spending as a share of GDP. And actually here, with only those variables with the interaction term with war, you end up to, 69%. Okay, good. The IMA strategy, very quickly, we rely on a paper by Jonathan and Moritz and Dominique, on the who wins war. And we compute a measure of financial windfall for each country, which is the sum across a bundle of commodity goods times the net exports of this country in those commodities. And this should predict a change in military spending. That's what you show in your paper. And actually, that's what we find. And then once we have for each country in the sample, the change in military spending as predicted by the financial windfall, we compute the predicted change of allied military spending, predicted change of rival military spendings, and we put that in the regression, such as we have the two-stage square. Okay, that has to be bootstrapped, of course. So that's the first stage. It works well. Financial windfall predicts change in military spending. Then it's the second stage of our military spending rule, and you see that the coefficients are fine. Okay, so that's what we do so far for the empirics. Now, let's go back to the model a bit. Well, no, not to the model. That's a retrospective, historical-based analysis of the spending rule, right? We estimate the spending rule on historical data. Now we want to have a prospective view, right? So, how should the military spending rule change after a major geopolitical change? Okay. So, for example, to set ideas, we consider the reshuffling of military alliances between US and all European countries after the J.D. Vance Munich speech. Okay? So meaning that we assume, in reality, I think you should go to your, that this is the type of model, like the model we have with Isabelle and Thierry, that at some point has to be fed with military intelligence and intelligence from diplomacy. But imagine your diplomats tell you, look, after J events, it's very clear that all the alliance links between the US and the European country should switch from 1 to 0. Okay. Good. What do you do out of that? Well, you estimate the model on historical data, you recover the security spillovers, then the model tells you, and all the factor loadings, then the model tells you, oh, you can build the retrospective hostility levels, model implied hostility level before the speech. After the speech, all those alliance links are reshuffled. You can compute based on your estimated security spillovers, based on the new network, what are the new hostility levels. You plunge that back into your military spending rule, and you compute the new military spending rule very easily. Okay, so you can, in particular, you can compute the new loading of military spending on GDP for Germany, France, Italy, etc. And this is given by this formula that you can estimate, well, you can quantify at this stage of the resolution. Okay, so you can do that for reshuffling of alliance network, for rivalry network. You can also do that, and just make this point because that speaks, I think, a bit to the round table of yesterday. You know, now there is a sense, the military, you go to the militaries and they will tell you now the warfare is changing, right? It's the equipment you need is very different. You need drones, as you were discussing yesterday. In the model, it means that, well, your militaries tell you, now we should use drones. That has an implication of the guns versus butter trade-off, right? It means that the real cost of military spending, of military equipment now is changing dramatically. You don't need super fancy airplane, you need drones. So based on this military intelligence, you can recompute the cost of military equipment, and you can use your model-based interpretation of your coefficients to recompute the new hybrid warfare military spending rule. Okay, and so in particular the loading. So that's it. We think it's a simple rule for observables have a high explanatory power. It takes into account strategic interactions. You know, the military spending rule of Germany interacts with the military spending rules of all other countries in the world. It's interpretable. All the coefficients have a clear interpretation, transparent, and it's actionable after major geopolitical risk. You can use this framework to recompute what should be your spending rule. Thank you.
Great, thank you so much. And let's start with the discussion by Ethan Kapstein. I think let's also have here.
I'm sorry.
Yeah.
Yeah.
That's okay.
Yeah.
Do you want to use this mic or this one?
Yeah, try this.
Okay.
Thank you. It's a great honor to be here. I have to say I'm a little biased because I love these guys' work, so maybe I wasn't the best discussant in that case. I'm positively inclined to anything they do. I also want to mention I'm really thrilled that we're having closer collaborations between the Empirical Studies of Conflict Project, which I direct, which is a multi-university network. It consists of Princeton, Emory, Stanford, UCSD, a bunch of former military officers who are all trained in economics or quantitative social science who 20 years ago set up, again, what's called the Empirical Studies of Conflict. We have an annual meeting. Jonathan took part in it last couple weeks ago, right, in Washington. And next October, our annual meeting is here in Paris under the leadership of Oliver van den Eyn from the Paris School of Economics. So I just want to throw that out there for people who are doing our kind of ESOC work. Look out for our call for papers. So that's my public service announcement. So this is an incredibly rich paper, incredibly rich, and I can only touch on some of the surface. But I think just to start off, there's a great quote from Ernest Hemingway, who all of you know as a novelist. Maybe fewer of you know that he was also a war journalist. And I think this is an appropriate quote. Wars are caused by undefended wealth. The authors argue that countries follow a military Taylor rule, which determines the optimal level of military spending.
And they use that phrase, optimal level of military spending. And they say that's analogous to the Taylor rule in monetary policy.
And they find that a small set of observables, which Mathias went over, explain most of the cross-country variation in defense spending. There's their kind of basic equation. And that parsimonious model explains a heck of a lot of defense spending, as Mathias already showed you. So again, just as the monetary rule relates interest rates to inflation and output gaps, the military Taylor rule links defense spending to a few key observable variables. And for those who forgot, they're financial economics or monetary policy. That's kind of the Taylor rule. So, one question to keep in the back of our minds, is this a good analogy? Right? So first, do central banks follow a Taylor rule? No central bank has so far made a commitment to a simple instrument like the Taylor rule. Taylor believes that the Fed has not followed the prescriptions of the Taylor rule. And what is the correct specification of the Taylor rule? There are dozens of alternative formulations. There are lots of different monetary policy rules, in fact, suggesting it would be interesting to know more about country-specific MTRs. What's the heterogeneity? You've given us some averages. What's the heterogeneous effects? For the Fed, for example, monetary policy operates to influence demand-driven inflation, but not supply-driven inflation. By analogy, is the MTR shaped more by changes in threat demand or by changes in GDP supply? So I just took the case of the United States. Just for example, this is a chart about what rule does the Fed follow. The Fed itself does not say it follows the Taylor rule. It seems that the best indicator, you learn in finance, the first day of finance, you read John Cochran, who tells you that interest rates predict interest rates. So like the last, if you lag the interest rate, you know everything about the future interest rate. So basically, what does the Fed do? It looks at the last interest rate, and then it gradually adjusts policy. And that's kind of the rule that it seems to follow. So this is defense expenditures versus the threat. So I took as a measure of the threat the Bulletin of Atomic Scientists Doomsday Clock. The Bulletin, this is a group of nuclear scientists. My father-in-law happens to be a nuclear physicist. And what they do is measure how far away we are from nuclear annihilation. The nuclear threat is the existential threat we face. So what's happened to defense spending in the face of changes in that existential threat? Remarkably, it's gone down. That seems kind of surprising to me. Now we're only 90 seconds away from doomsday. Yet military spending in the United States continues to fall. So I don't really see US military spending responding to the threat in this chart. Yeah? I mean, it's true, the threat, we go from 2 minutes to 3 minutes, but defense spending falls by half in that time. So, and then it continues to decline. It's about 3%, 3.5% of GDP now. Some people would say it's a fairly threatening environment out there. It seems like a better mapping is US defense expenditures to GDP. The change in US defense expenditures to the change in US GDP seems like a much better mapping of what's actually going on. So that'd be a really parsimonious theory. So the authors use analogical reasoning. A false analogy means the rules of the source domain A fail to explain the target domain B. A famous example of that, I'm sure you've all seen these articles like in Scientific American, black holes are cosmic vacuum cleaners. But no, they're not. A black hole is not a vacuum cleaner, right? A black hole doesn't suck stuff in, right? Eventually a black hole, deals with gravity, the gravitational pull, and then stuff falls into the black hole. But it's not a vacuum cleaner. So it's a kind of poor analogy. So the analogy to monetary policy, I think, hides an important asymmetry. And that is that central banks gradually move interest rates in response to inflation, chart I showed you. Military spending, by contrast, is punctuated and discontinuous. Periods of peace regime switch. And there's a profound regime switch here to war. Defense consumption goes from being a normal good to a superior good. So again, this regime shift. So the MTR may describe average behavior
but it's unlikely to predict the peaks and valleys that drive most of the variation in defense spending, and that fit could come from everyone increasing their defense spending together during wartime, rather than countries systematically following the same rule. I think there's also this question, what does the MTR optimize? I think the Taylor rule in central banking is a technology for stabilizing expectations about inflation, thereby contributing to consumer welfare. But defense spending doesn't really perform that same function. The MTR is not optimal in the sense of welfare maximization. As Mathias said, it's a best response to the strategic environment. That's kind of a different thing, right, in a way. And the point is, the best response in the strategic environment can lead to tragedy. That's what the prisoner's dilemma is all about. That's where you get arms races, over-arming, mutual insecurity, a prisoner's dilemma or Nash equilibrium kind of pattern of behavior. Further, the MTR, which you say is normative, doesn't even guarantee me peace or victory. So I'm not sure I buy it as normative guidance. Is that really a good normative instrument? I mean, the United States has lost a bunch of wars. You know, are we spending the money wisely, correctly, whatever? More generally, as I said, the authors estimate one particular form of the MTR, but countries may adapt not just the variables they cite, but to others like technological change, nuclear weapons, which you kind of alluded to. So the model's sparse and elegant. You might want to explore MTR heterogeneity by regime type, geography, proximity to conflict zones. Are democracies more rule-like in their behavior than autocracies? On the empirical side, the use of trade-based fiscal windfalls as instruments is clever, but I think it relies on a really strong exclusion restriction that global price shocks affect defense budgets only through fiscal capacity, not through changes in threat. So think about oil shocks. They not only change revenues, but they reshape global security priorities. So you think of the US after the Arab oil embargo, which stands up a rapid deployment force. So I think there's a risk that the instrument captures direct geopolitical effects and not just the fiscal effects, right? So there's, I think, a problem there. And I'd like to see how stable the coefficients are over time, if they change, how and why. So about to wrap up. I think it's a great contribution to the literature. I mean, it's a really cool idea that there's a rule. There is a ton of literature. I think you mentioned it, Mathias. There's just a ton of literature on defense spending. Most people who write on it don't call it a rule, but they do say that governments are trying to maximize some kind of, or optimize some kind of social welfare function. Ron Smith has a great review paper. You know, there are hundreds of studies that do this. I think the idea that this is a rule is novel and maybe something you can exploit, though I'm not convinced yet of the analogy. So I think you have to elaborate the theory. Are government decisions over defense spending really analogous to CB decisions over interest rates? Is the MTR primarily descriptive or normative? If descriptive, maybe you should look at other rules. If normative, how useful given its failures to deter or defeat an adversary? I think you should flesh out the empirics, maybe consider a case study that shows how policymakers actually make defense spending decisions, or at least use some text as data, as scholars of monetary policy do, right? They use central bank announcements, they use text as data as a way of testing, you know, which rule is the central bank following. And I would clarify what's new here. As I say, many studies argue that military spending is a function of GDP threat. They debate the role of alliances. There are hundreds of papers like this. So less research, though, I think, on why that chart I showed, why military expenditure is falling. Why is it falling, despite even a fairly stable threat environment? And I don't think you really explained that. So maybe the role of technological change is one avenue to pursue. So thank you very much. A lot of fun.
Thank you very much. I think in the interest of time, maybe we collect like one or two questions, and then you can answer the comments as well as the questions together. Okay, great. So then, if there are questions from the audience, yeah, okay, I think one's there.
So first of all, very interesting paper, and I think that the aggregate relationship that you find is, I would say, very interesting. And I was wondering about two facts. One, about the spending, because it's a bit of a black box military spending can mean investing in hiring more soldiers, or it can mean investing in building long-range missiles, and those have very different implications and relationships with the military threats. And the second one, so maybe you could unpack somehow more what you actually mean by military spending. And second, I was thinking that the effect of spending, military spending on GDP is very different depending on the countries you observe. Because, for instance, in in Europe, we are kind of forced to buy American weapons, and the effect on the GDP of the own European countries is different from the fact that this investment has in the same amount of dollars on the American GDP. So if the Americans spend $1 in military spending, it has a different GDP implication for themselves than it does on the GDP of, say, France, if it spends $1 in American weapons.
Okay, and then one final question there, and then we have to wrap up with some short answers.
So if I understood the model correctly, there is a common pool / free rider problem within the alliance. Everybody's just playing Nash related to. In the real world, these countries typically have some kind of alliances where they are forced to spend a certain % of GDP, and so in some sense it seems surprising that you can match the data, because in reality they're spending collaboratively, and you're finding, and in your model they're free riding on each other.
Okay, so thanks for all those questions. Thanks, Ethan, for accepting to discuss the paper. I must say that the draft we sent you 2 weeks ago is quite distant from the slides I presented today. So, yeah. Thanks also for reminding us the virtue of logic and what is a sophism. I mean, well, yeah. Okay. Maybe we should change the title, or maybe we should different. But I think most of the paper is really not on the military, on the Taylor, right? But it's well granted. Okay, I'm sure we'll have a discussion within the team on the title. Why is it falling? US, I think it speaks to one key aspect of the approach, which is we really model how allies and rivals spending also affect your own spending. And actually, in the network of alliances, the number of alliances that have been signed by the US since World War II has increased big time. So that goes in the direction of what the rule tells you, that as the number of alliances and the web of alliances you evolve to increase, then you free ride more on the other. So there is a model compatible or model consistent way of explaining what you consider to be a puzzle. Heterogeneity, the model is super heterogeneous to some extent. Every country may have access to different technologies, different worries, different. So I think we do well in terms of heterogeneity. Maybe it was not so transparent in the draft, but I hope the slide make it clear. And to some extent, given this high level of heterogeneity, given we solve this Nash equilibrium, it's quite surprising that at the end we can characterize again in closed form, and I'm insisting on that, closed form characterization allows us to do something I think the big literature you're referring to does not do, which is a structural interpretation of the coefficient. A structural interpretation of the coefficient means, again, sorry for repeating, that you can do this very important step, which is you estimate your key elasticities, which are those security spillovers. Never, first time they are estimated, right? Because meaning that you regress your military spending on alliance and rival military spending. So we are the first to come up with those estimates of security spillovers. Then you can use those elasticities to, recover all the other parameters. And then Vance comes, you reshuffle, or the military tells you, no, we should go for drones that change radically the type of equipment you should buy. Then we can naturally recompute all the loading. And I think that's something that is quite specific to this. Exclusion restriction, you're right. One way to go first is a bit defensive argument is to say we control in the second stage, we control for the country has own financial windfall. Okay, so that's a first way to maybe a bit the counter. Second thing is that we could restrict commodity prices to the set of commodities the country is not a price taker. It is only a price taker, sorry, not a price maker.
I think in the interest of time, we have to maybe like one or two
No, you're fine. Thank you for the other question. Coordination, I think that would be the next step within this paper or other one, I don't know, but to see, to endogenize the alliance network and to see how you can solve this free riding problem. I think your point, which is a very deep point, is to say, look, it seems that actually the inefficiency of the free riding problem is not that big because you manage to match the data. And I think that's a way of interpreting what you say. So meaning that maybe we should have a model of collusion, alliances as collusion in military spending. Thank you very much.
Perfect. Thank you so much, and thanks all for being here. And after I guess very quick break, there's going to be the policy panel that starts.
So welcome to the very last session of this conference. We are heading towards the end, and so we are going to finish with this roundtable that I'm very happy to moderate. So the title of the roundtable is Global Trade at a Crossroads, Economic and Geopolitical Consequences. And to discuss this kind of heavy and complicated topics, I'm very pleased to host a great line of panelists. Unfortunately, we had Mr. Dorothée from the European Commission cancelling a bit last minute, but still we have three distinguished speakers to discuss this topic. So starting from the end of the line, Dorothée Rouzet, who's the chief economist of the French Treasury. Bob Steiger, who you know, who spoke this morning as a professor at Dartmouth College, who hopefully is going to talk a little bit as the designated chief economist of the WTO, even though he doesn't want to. And finally, Marion Jansen, who's the director of the OECD Trade and Agriculture Directorate. So I don't need to spend too much time introducing the topic. Over the past few months, there has been very important developments in world trade. They've been both rapid and disruptive. The trade confrontation between the US and China has escalated, somewhat complexified with additional instruments being put on the table, such as export restrictions. At the same time, a few partners, including the European Union, have signed trade deals with the US. And I think it's fair to say that the economic and strategic consequences of those deals remain quite uncertain, and maybe we're going to talk a bit about this. And of course, the war in Ukraine is still ongoing. The sanctions on Russia keep on redrawing trade routes, reshaping global energy flows, and raising fundamental questions about the links between economics and security. So taken together, all these developments have been raising important questions about the future of the global trading order. Among those questions, some that I would like to tackle in this panel, should we continue to view trade as a stabilizing force, or should we accept that now and in the near future, this has become a tool of geopolitical competition? What does this new context mean for Europe in particular, and for Europe's economic model and strategic autonomy? Hopefully we can talk a little bit about the WTO and what the WTO can do in this kind of mess, or the other way around, is it still worth saving? Who knows? So given this very broad set of questions, I'm going to try to be a little more specific afterwards, but maybe I can start with a very general question for all the panelists. Something like, from your institutional or national perspective, how have all these developments changed your views about what an optimal global order should look like and what role trade should play in it? So maybe, I don't know, Dorothée can start.
Okay. Thank you. I'm not sure I can define an optimal global order, but maybe saying a word about what all this has changed very quickly, and I'm sure we'll talk about all of these things. I think the first thing is that we can't think of trade as just trade anymore. I mean, you said it, it's been said many times. Trade and geopolitics are imbricated. We see that trade relationships can be weaponized. So the challenge here is a bit, first in terms, I guess, institutionally, that when you negotiate trade, you are also negotiating on a lot of different things. With, I mean, the US example tells us it's also energy, defense, security, national regulation, digital regulation, etc. And that poses some very institutional challenges. And on trade itself, it's also finding the right balance between resilience, economic security, sort of reducing dependencies, and not losing the benefits of open trade. And I'm sure we'll talk about that.
Okay, great.
Okay, of the three up here, I am definitely the least qualified to be speaking in this panel. I am definitely speaking as professor of economics at Dartmouth, not a WTO representative. I'm not even there yet. That won't come till January. That said, I think when I look at trade agreements, the first thing I think of is why do countries have trade agreements and what's the purpose? And to me, the purpose of the WTO and the gap before it is to help countries internalize the externalities that they impose on each other with their policies. And my view is those externalities tend to be pecuniary. They travel through trade. Those are the externalities that countries are trying to internalize with each other. And when you look at it that way, then the question that Isabelle asked, I would say as well, has the purpose of a trade agreement changed relative to what it was 50 years ago? And I think that there are many, many challenges that we're facing. We'll be talking about many of them today, I'm sure. But I don't think those challenges actually change the key features of what a trade agreement ought to do. And I believe that the GATT and the WTO is designed at its basic core principles in a way that is pretty good at internalizing externalities. So my view is, yes, these are huge challenges, but I would still support the basics of the institution.
Thanks. Does it work? Yes. Well, let me follow up on the terminology used by Bob. Would we question the benefits of trade or the benefits of the WTO at the OECD? And Bob, you're lucky you speak as Dartmouth professor. It means you can still speak. And so I speak on behalf of the OECD. Yes, we still consider that open markets brings benefits. Can the system, is it sustainable in the way it is? That's maybe not the case. And maybe there are we consider 4 aspects important that need to be addressed. Maybe only 2 of them fall under the pecuniary aspects that you mentioned. So first, in the original trade agreements, I think the idea that high levels of global concentration can lead to vulnerabilities in supply chains that then lead to supply chain disruptions, either because of coercion or because of external shocks. That's not foreseen in the agreements. The second point, having a level playing field that was always supposed to be in the agreement. There is notably a subsidies agreement, but many will currently consider that the agreement doesn't function in the way it should be functioning in the current context. So yes, the WTO was designed to address subsidies. It's not working, not sufficiently. No, the rules have not been designed to address supply chain trade. I mentioned this because the concept of supply chains didn't exist when the rules were written. There are 2 additional aspects that are externalities, and I'm not sure whether they would, in your framework, fall under monetary aspects that can be handled. Everything around inclusiveness, sustainability, that has been environmental sustainability. It has been known for a long time that the concerns exist in the WTO memberships. Those concerns should ideally be addressed elsewhere. It would be good to have a World Climate Organization or to have the International Labour Office playing a different role. Hasn't been addressed sufficiently, and now if it's not addressed, then maybe the way to address the problems is to trade differently or not trade anymore. So that's a question mark. And the fourth one, a new area we're looking into, the safety of trade. That was not on the agenda at all in the past. Has trade made it easier to bring illicit products into countries, including through the new digital and parcel types of trade? And that's a new field that we are looking into and that policymakers are interested in. So 4 points that may need to be addressed without questioning the fundamental benefits of trade.
But so just pushing a bit further, and maybe Bob, you can react to this. So basically, if I understand what you're saying or what you said this morning, basically your view is that there is potentially some need for more flexibility on different dimensions of the way the WTO is working, but the ultimate goal would be to recover a bit more flexibility or some ways of addressing some of those externalities that were just mentioned without changing the system entirely. And I see your point that the kind of reason why we build the system is still very much there today, but there are also a number of new challenges that were not taken into account. So how do you think about those challenges? Do you feel that, in a way, they are second order to the way the system is functioning? Or I mean, I understand that this is a bit what you just said, but talking specifically about these different externalities, and for this panel, I guess the security concern, the fact that we need to have countries that are not geopolitical rivals working within the same system, isn't it like kind of questioning the kind of core functioning of the system? Or?
Yeah, so I think some of the key challenges that the WTO is facing today are the core challenges to the core principles of non-discrimination and reciprocity. And reciprocity in the GATT and the WTO is a very different definition of reciprocity than the Trump administration is proposing. It's what Jagdish Bhagwati called first difference reciprocity, that this is reciprocity in negotiated market access commitments rather than the level of market access equality that each country is offering. And non-discrimination, of course, is embodied in the MFN principle of tariffs, and we're seeing that also being eroded dramatically by what the Trump administration is doing. And I don't think I'm releasing any state secrets. The USTR, Jameson Greer had a New York Times op-ed that said we are proposing a new world trading system for the world, and it's going to look the way we would like it to look. And I think those the features of that world trading system are very much getting rid of non-discrimination and getting rid of reciprocity in the way that the WTO and GATT has always defined it. And I think those two key properties have a lot of legitimacy as rules and norms that can help solve essential market access externality problems. And what Marion is mentioning, there are definitely other problems in the system: climate change, the question of digital trade and illicit products. And these are what I would view as non-pecuniary aspects that the WTO, it's not its primary expertise to deal with these. It certainly has to help deal with these and accommodate other agreements that would deal with them. My own view, though, is the role of the WTO, for example, in climate change, is to have rules on carbon border adjustments, et cetera, that accommodate the climate agreements that countries negotiate, rather than to actually take the lead on climate. And I think that could be argued also for other non-pecuniary externalities. I think the expertise of the GATT from 1947 has always been on market access, on trade issues, and I think that's the expertise that it is best equipped to continue with. That said, the other point that Isabelle was making, and I think also Marion, was there are other challenges. The geopolitical challenges are very real. I think the geopolitical challenges that the world faces between U.S. and China are kind of maybe brought together in several different challenges that China faces the WTO with, and one of those is It's more non-market aspects of the economy in China, and how a system that has traditionally been created under the GATT, a system of rules that was supposed to discipline market access commitments that countries could make to each other in a way that there would be a system of legal property rights over negotiated market access, sort of like a Kosian view of how you would solve an externality problem is you get the property rights over the things that are causing externalities, and then you let countries negotiate. That's very much how I see the original GATT was formed. Well, that system of property rights, which was we commit to market access through tariffs, and then we have a series of articles that prevents countries from undercutting the property rights that they've agreed to on market access by domestic policies and other things. That works or has worked fairly well for market economies, but it was always understood that it would not work for a non-market economy. And it's kind of interesting to think about the satellite countries of the Soviet Union that began joining the GATT in the 60s and 70s. And Poland is a great example that Poland joined the GATT in 1968. It was never considered at the time to be transitioning toward a market economy. It was always thought to be going to be a non-market economy. Of course, it did transition, but that was before. That was well after it joined the GATT. And so how did the GATT member countries deal with this? Well, they understood completely that the problem was they wanted Poland to have disciplines in the same way that all the other GATT members did in terms of their commitments to market access. They understood that tariffs meant nothing in the Polish economy because you could reduce a tariff. It might affect prices, but prices didn't really have an allocative role. And so what the Articles of Accession for Poland were 2 paragraphs. One paragraph said, Poland agrees to increase its multilateral imports from GATT members by 7% a year. And the second paragraph said, after 3 years, all the members will revisit this and see if we've achieved reciprocity. And if, in fact, Poland's exports have grown by more than 7% a year, then we'll ask Poland to increase its imports by more than 7%. And if it's grown by less, then we'll lessen. And the whole idea was to establish some kind of broad reciprocity as other GATT members were committed to. So I'm not suggesting that China should be committing necessarily to quantity measures, but I think there is a history of the GATT and now the WTO membership dealing with countries that don't necessarily have strong or complete market principles in their domestic economies, and yet countries have found a way to have those countries make disciplines that have become workable. So that's just a long-winded way of saying I think there are many issues here. Some are geopolitics, some of the non-market aspects, other things, and I think though that the core principles of the GATT can be harnessed to solve these problems.
Okay, so I was about to ask something else, but I think this question of non-market practices and how they are challenging the way we think about trade and also access to our markets, whether in Europe or in the US, is maybe worth discussing a bit further. So, for instance, I mean, the European Union is very much exposed to this type of issues. France has been pushing a lot the question of strategic autonomies or thinking about open trade policies in light of some very big amounts of industrial policy. So I'm sure Dorothée is going to have interesting insights on those.
Yeah, no, I think I agree. And just to say, yeah, one more word on WTO. I think I agree there's sort of 2 kinds of challenges. One is geopolitical, is that, I mean, in a way, the cooperative equilibrium has been sustained by having the US as the big player willing to sustain that order. And without that, reverting to the Nash equilibrium is pretty ugly if we see that. So the question is, I mean, how much flexibility can we try to build into the system to avoid that? And the other part is more along the lines of what Marion said, to deal with issues that were not built in because they were not so prominent when the rules were designed, and sort of accommodating climate agreements in a way and making sure that the trade rules don't run counter to it, but also non-market practicing, and in particular disciplines on subsidies where those are say. On non-market practices, I think there's, there's an inherent tension in open strategic autonomy, which is the agenda of the Commission that France has been very supportive of. The idea is to, try to find a way to deal with overcapacities that is coherent between the industrial policy side and the trade policy side. So on the economic security approach, that's more at the Commission level, and we were supposed to have someone from the Commission, but I'm happy to talk a bit about that. I think the challenge in the strategy of the Commission is to keep this balance between the different ways of dealing with economic security challenges, be it non-market practices or critical dependencies. And there, the economic security strategy by the Commission, which dates back now from 2 years ago, has kind of 3 pillars, which is protect, promote, and partnerships, 3 Ps. And of course, the challenge is to try to take into account the interactions between the pillars and keep a balance between there. Being both open, because in a lot of ways, the answer to dependencies is to build more partnerships with maybe more aligned countries. That's not always possible, but that's possible in a number of countries. So build more trade agreements with, friendlier countries. And on the other side, on the protect and promote side, it's more dealing with non-market practices, with some trade, a more assertive use of trade defense instruments when they're necessary, and also having an industrial and promotion strategy. And I think in critical materials, that's typically the balance that we try to have. The EU pretty much does not produce rare earths or critical minerals, so we don't really have an option to produce more. We do have the option of building more processing and recycling capacity, but at the same time, diversification of supply sources and partnership with countries outside of China where possible is also part of the strategy. So there's always a bit of this tension between the different pillars, but that's a challenge we have between, openness and assertiveness in some ways, between the open trade and the industrial policy strategy, and at the EU level, we're trying to make sure that this trade agenda and this industrial policy agenda align, but that's a kind of a sector by sector and case by case approach.
Very good. So maybe I could ask Marion to as the member of the working for the OECD. So the OECD has long kind of pushed the arguments that trade openness is a source of wealth, productivity, innovation, welfare. But in the meantime, your very department has been working a lot on value chains, their resilience. This morning, Paul was arguing that we don't take enough into account this question of value chains and their resilience to shocks. So it seems that things are moving a bit, including at the OECD. I was wondering the extent to which, when you work on these issues at the OECD, you also incorporate, or how do you think of geopolitical challenge, geopolitical tensions, and how do you think these topics challenge your view about the benefit of trade openness? How do you think about these questions within this kind of framework? So another way of saying this is that, should we think that we're kind of entered a fundamentally different world for global integration, and we need to kind of think very differently about trade and openness in this setting?
Mm-hmm. So in my job, geopolitics is the frame of my work. I work within the geopolitics of the day. Yes, my teams conduct analysis, collect data, but in order to publish anything, we have to get approval for the publications by a so-called committee. And who sits in that committee? People like Dorothée. It's representatives, in my case, from the Trade Ministry. And these people will, first, they tell us what they want us to work on. So if they are concerned about supply chain resilience, they will ask us to work on supply chain resilience. Second, they will only allow us to publish things that fit with what they want to message. So when you read OECD papers, keep that in mind. On trade, I know there are colleagues from other directorates that have more freedom. This is agreed by 38 countries. Now, that takes away a lot of academic freedom, but in the current context is absolutely fascinating because we work close to what those 38 countries want. So what do they want? They wanted to understand better supply chain resilience. How come that there are little, how do you call them, tipping points? No, there's another word for this. Critical points in the supply chain, choke points. And I didn't know about it. And 2 years ago, I was every day getting calls in 2022, 3 years ago, from ministries or ambassadors saying, Marion, where is my next choke point? And what was my problem? I didn't even know how to start analyzing this. We had no tools and no data to look into this question. So, and Dorothée knows this, I called Emily Blanchard, she was in the State Department at the time. She said, what are you doing? She said, I don't know, we have no tools. I called other chief economists in trade ministries. What are you doing? We are improvising. I'm improvising too. Doesn't feel good to be improvising at my age. When policymakers have really important questions. So we created something that was at the time called the Supply Chain Interdependency Network. Now it's called the Trade Chief Economist Network, where we brought regularly people together to discuss how they analyze supply chain resilience. And guess what? Those meetings were under Chatham House rule and confidential. I've never done academic meetings under Chatham House rules, but it was considered sensitive. So this topic is important. We didn't have enough tools. I'm not sure whether the toolbox is strong enough now to analyze this. With regard to this, you mentioned, Bob, externalities, for instance, in the environmental context, and that it would be great if the WTO cannot solve it, but there should be agreements that the WTO agreements can refer to. Well, not only do we not have enough tools to analyze supply chains, the EU came up with answers to this challenge with a whole battery of supply chain legislation that completely did not fit within the WTO framework. If there's something that has been disruptive for trade policy analysts working on WTO-related matters, so close to WTO law, these are the supply chain laws. That also includes the Forced Labor Act of the United States. No idea how that works within the WTO agreement, no idea how to make cross-references. This was a very extremely disruptive element because subsidies, tariffs, at least we know how to look at it through the lens of the law or the agreements. So do we think we need something fundamentally different? We think we need to find answers to these important questions. Supply chain resilience is since 2023 part of the OECD trade strategy. We need to find answers to these non-market policies and practices. That's the term. If you work on subsidies, export restrictions, use in your abstract the term NMPPs. Policymakers will Google that term and will find it. NMPPs is the buzzword of the year. We have to address this. We are working on non-market policies and practices. We are trying to understand how supply chain legislation or standardization can be integrated in WTO-ish thinking. And we are starting to work on safety of trade, notably on the issue of illicit trade. So the 4 areas I mentioned before, we think they have to be addressed in the new multilateral framework. I would expect that this framework is a combination of cross-references to other rules, like you said, that hopefully are going to be created somewhere else, and new elements in the multilateral framework.
Okay, good. That's not that easy to moderate a panel like this. So let me maybe again come back on this question of non-market practices, which is a very hot topic, as you just said, but is also, comes at a time that, another hot topic is also industrial policy and the level of industrial policy. And the same country, so basically China, is often accused of non-market practices, while in the meantime spending a lot in industrial policy. So we are talking about a country that spends like 4% of its GDP in industrial policy. So when we ask about this question, at least coming from, more academia and being asked about those questions by policymakers, there is always a bit of a difficulty like measuring those non-market practices. So what is it that we should call overcapacity? So how do we think about overcapacities versus countries that have maybe more fiscal space or more, ability to spend a lot more than we do in industrial policy? And so how should we, how do you think about the balance between these two elements? So both like maybe the need for more industrial policy, maybe not, but at least a number of people are calling for more money put into industrial policy versus how this money is used and the extent to which it fulfills the kind of rules of the game. So I don't know, I don't know if the question is clear, and I don't know if someone wants to respond.
G7 presidency. Measurement is yours. No, I think, there is a difficulty when we talk about overcapacities about defining exactly what we're talking about. Anyway, I would say we know it's there. Putting a number on it is hard. And I think there's, so Marion can talk about the work the OECD is doing in trying to measure the non-market practices or by category of industrial subsidies. And yes, you do see that China is doing more of it than everyone else. Everyone else is also doing it in some ways. And it's true, sometimes we can point the finger, but we perhaps would like to be able to do as much. So there's always a bit of a tension there. On industrial policy itself, I think there's also, I guess, within the EU, there's internal EU rules on state aid and what you can do. So there's also more discipline put at the EU level that ensure that it's not too distortive to competition, that it's not too discriminatory. But then when we compare ourselves, so there's a question of scale, I think, between what China is doing and what others are doing. There's a question of exposure to, what happens when you go on external markets and the implications for exports. The Chinese policies are very much directed towards export markets and export dominance. There's a lot of competition within these Chinese internal markets, but it's directed toward export markets, which is not necessarily directly the case with others. And I think maybe the last point is how do you know it's overcapacity? I think you also have to look at the economic data. If we move away from the sort of industrial policies one by one, and we can probably debate one by one, to what do you see on the more macro side? What do you see on the more macro side? You see deflation, you see excess capacity, capacity utilization rates that have been falling in pretty much every industry. Investment in capacity is still going up by domestic Chinese actors, but investment in capacity by FDI is going down. So basically you have a situation in which you have excess, you have low capacity utilization, but you're still investing in extra capacity while prices are falling. And this tells us it's not market forces at work. If market forces are at work, normally you don't see the situation, especially when foreign companies are saying that it's not really worth investing in extra capacity in the same sectors anymore. So I think we have to also reconcile a bit the micro and macro view to get the diagnosis there. But again, when you talk about overcapacities, it's not something consensual about what exactly this phenomenon means and how to measure it.
So maybe on measurement?
So how to explain this? So if coming back to the World Trade Organization and this concept of we would like to trade with each other, of open markets, what WTO rules do is that they try to ensure that trade is fair in the sense that it's not the government is not helping its private sector to be able to compete. Now, therefore, there are rules on what policies you can use or not use in order to be part of the WTO. And there is a countervailing agreement on countervailing measures and subsidies that says how you can or cannot use subsidies. So the WTO said subsidies can normally not be used only in certain conditions because you will probably be distorting the market. That makes sense from a competitiveness point of view. But many countries felt, our members felt, China is subsidizing, but for some reason the WTO dispute settlement doesn't manage to prove it. And members like the US were losing one dispute after the other. And because that continued and continued, what was the result? They said, okay, then we do not appoint appellate body judges anymore, so we weaken the system. The failure to win subsidy cases is core to the challenges the WTO has, and will be solving that problem will be core for WTO reform. So now you can do two things. One is to say, how come the WTO couldn't measure those subsidies? How come they couldn't see it? What we do at the OECD, what we saw is that the WTO relies somehow on the concept of identifying how much money the government gives in terms of subsidies, and they use for this government information from governments about subsidies. And that wasn't working. So instead of using government layouts, we went to the financial accounts of companies and identified subsidies from the financial accounts of the companies and developed a way of measuring those subsidies. So we have now a database, it's unfortunately not public, expressing subsidies in terms of percentage of the firm level revenue. So not in terms of percentage of GDP or overall layout of the economy. We look at the firm level. Now, when it comes about distorting competitiveness, assessing at the firm level is actually a very valid way of measuring. And originally the idea was that if we understand how these measures work, then this could help us to design new subsidy rules that hopefully work better in the future, potentially subsidy rules at the WTO. So we are still working in this direction, and that database is being used by the trade ministries from our membership. But whilst this isn't working, some members said, okay, the problem is going on and on and on, and when we lose the solar panel market, wind turbines, we are going to lose e-vehicles, we already have a problem in steel, what can we do? So they said, well, let's just stop it. And let's maybe use as a trigger for intervening, not the policy, not the subsidy, but a phenomenon in the market. And the phenomenon that was chosen was excess capacity. Now, we cannot measure, we don't really know what it is. We cannot really measure it, but that was taken as now the trigger for acting is excess capacity. Members of the OECD and others are currently negotiating under the OECD an agreement under the Global Forum for Steel Excess Capacity. It's very initial stages, but they met in the margins of the G20, and that's all public. And there the starting point of action is the excess capacity. So that goes back to the question, could maybe in a future WTO agreement, the starting point of a provision be something in the market, be it excess capacity or a concentration or dominance in the global market? It would be a different way of thinking that is closer to the thinking in competition policy. And that would be a new way of addressing it. So yes, we measure subsidies at the firm level. The measure we are mostly referring to in the policy debate is percentage of firm level revenue, and there we have most of the time the Chinese subsidies being double compared to what our OECD membership has, and the sector most subsidized with that measure would be solar panels by far. and the excess capacity, I think I would see it logically as changing the starting point of triggering an intervention.
Okay, I don't know, Bob, if you want to
Yeah,
give us a bit of a US perspective on this debate. No?
Subsidies is such an interesting issue from GATT history and trade agreements, and it has a lot to do with what Dorothée and Marion are saying about measurement issues. And the interesting thing, in the original GATT, the subsidy rules were extremely weak, and they were very much tied to negotiated market access. So I was mentioning before that the one way to think of the GATT, it was a legal way to create secure property rights over negotiated market access, meaning the conditions of competition between foreign exporters and my import competing firms. And in the original GATT, the only illegal subsidy, and it wasn't illegal, the only actionable subsidy was one in which I had negotiated a tariff cut with you, and then after I cut my tariff, I introduced a subsidy to my import competing firms and undercut the conditions of competition that I was claiming to give you with the tariff cut. So in the original GATT, that was not a violation because there was nothing that said I couldn't do it. But what it was a so-called non-violation. The non-violation claim was used in the original GATT to address these kinds of subsidies. And what the non-violation said was, well, if a country takes a non-violation claim against me and succeeds in getting it, I don't have to change my policy. I can keep my subsidy and I'm not violating any GATT rules. But if I don't change my policy, the other country gets to withdraw equivalent concessions. It just gets to re-even the balance of our original concession. And that was the way that subsidies were monitored in the GATT in the first several decades. But it quickly became difficult, of course, to have these non-violation claims successful, even though one of the benefits of a non-violation claim is it did skirt the measurement issue a little bit because I didn't have to actually detail the measurement of the subsidy that I was claiming you were giving. I just had to say, your government took an action which I could not have expected, and it undercut the market access that I thought I was getting in the negotiation. That's the legal hurdle for a non-violation claim. So it was, in some ways, a very artful way of dealing with what exactly you two are talking about now, which is, of course, we fast forward to today, subsidies are much more pervasive, much more rampant, and what happened is in the 70s there was a subsidies code negotiated in the GATT, which was to try to start handling some of the subsidy issues that were out there. And then in the WTO, the SCM agreement, the Subsidies and Countervailing Measures Agreement, was negotiated. And interestingly, in the SCM agreement, for the first time explicitly, subsidies were defined as illegal even if they didn't have anything to do with a market access commitment that I had made. So there was a severing between what we'd say are illegal subsidies and whether that subsidy actually could be viewed as undercutting an agreement that I'd made with you on market access. And as an economist, that is a really interesting development because we all know that if we're thinking about Pigouvian intervention, subsidies are, of course, part of what we would often want to do. And in fact, the SCM agreement defined an actionable subsidy as it had to be specific. So it had to actually be targeted to a particular action, like your production of a particular product, which would be the poster child for a Pigouvian subsidy if I have a positive externality to that. So in some ways, I see where we are now with industrial policy, has grown as coming head-on into the economic inconsistencies of the way the SCM agreement was written. I just don't think most economists would look at it and say, actually, from an economic perspective, the way you defined what's an actionable subsidy is actually really hard to defend. So where do we go from there? I totally agree. That the SCM agreement needs to be reformed, needs to be changed. How do you do it? And reiterating, I am speaking as myself from Dartmouth. I am not speaking as any WTO representative at the moment. But if I'm speaking as myself, I would say, well, the subsidies issue has always been difficult. It's a difficult issue to deal with, always has been through the history of the GATT and the WTO. And it may make sense to try some new ways of going about it. One new way would be to not try to write one-size-fits-all rules about subsidies, which is what the SCM tried to do. It tried to define what is a bad subsidy and what is a good subsidy or an allowable subsidy, but instead perhaps go, first of all, sector by sector. In certain sectors there may be problems and maybe we want to have tighter rules on subsidies in certain sectors, maybe sectors where there seems to be chronic overcapacity, however we decide to define that. We might even want to have different rules for different kinds of countries. If I am a country with strong non-market aspects, maybe we shouldn't be writing rules that try to cover all countries with one size fits all, including countries with non-market aspects, but rather have some country-specific rules that achieve the same disciplines as the subsidy rules we write for more market-oriented economies, possibly. Or we might want to even treat subsidies the way we treated tariffs. The way we treated tariffs was tariffs are not illegal. I can have any tariff I want, but I can negotiate a commitment to lower my tariff if you lower yours. We could have negotiations over subsidies in that way, that I might come to another country and say, your subsidy on your shipbuilding is really hurting me, and that country might say, well, your subsidy on your steel is really hurting me, so let's agree to a commitment that we will both reciprocally lower our subsidy. And that's the way tariff negotiations work, right? That is the tariff commitments in the GATT. Those have worked quite well. So possibly, that's another possible way of going with subsidies. So bottom line is there are many possibilities. It's a really difficult issue. I do think that the WTO membership, they absolutely need to address it, especially with the rise of industrial policy the way it is now. But I don't think it's beyond addressing.
Excellent. So I do have questions on my list, but I want to make sure that people that have questions can ask them. So maybe we can do a pause now and just take a few questions. Yeah.
Thanks, Tara. I would like to come back to the China issue. Up here, Moritz. Sorry, I was in the back doing other things. So there's a lot of debate about the second China Shock 2.0. First question is, I guess, to what extent do you and the second China Shock hitting Europe this time and after sort of being in the US and then in the first time. Then I notice in these debates a certain disconnect that very often we say, oh, we didn't really pay attention to the political economy of the first China shock in the US, and now we have to deal with Trump. And then now is the second round, potentially, if you agree with the diagnosis. And a typical trade policy panel would say, yeah, but in no case we can do things to cushion the political economy. I mean, not in no case, you're not saying this, but there's a certain disconnect of trade economists saying, well, we didn't take the lessons of the first China shock on board, and what we recommend now for the second China shock is not so different from what we said then. So sorry for the long-winded question, but that's what I want you to think about. Thank you.
So who wants to respond to this one?
I can give it a stab. I think I wouldn't say we haven't learned a lesson from the first China shock. If anything, what we have learned is that saying that we will find a way to compensate the losers doesn't work. In practice, we don't know how to compensate the losers. Now, if we think about what is if you say China shock now, or what is the looming China shock, I think it's twofold in what we already see. One is industrial, and that's, I think, what we've all been talking about. And there we have to, I think there's a lot more awareness of the need to keep certain industries. I think the danger here is to also, to me, the danger from the policy side is not to say, oh, we shouldn't do anything. It's more to say, let's protect everything. And I think, on the European side, there's a lot more willingness to use the trade defense tools, but probably, maybe some industries will say it's too late, it's too small, etc. But I think if we compare to just a few years ago, the use of anti-dumping, anti-subsidies, there's more willingness to do it for some industries. I think we have to be a bit nuanced in what we want to protect from non-market practices, not just protect because we're not competitive anymore, and pick our battles in some ways. In some sectors, I mean, China has already won. You can't say, well, let's protect solar panels and the solar panel industry will come back to Europe. It's too late. For wind, we're sort of in the middle, and we can think about it. For some sectors like, well, I mean, EVs, obviously, if they're deemed critical enough, then you can at least have a policy debate about whether you want to incur the cost of, slowing down the entry of Chinese EVs, which means also slowing down the transition in some ways or having impact on consumers, but to keep your industrial base and not be dependent on China for strategic sectors. But I think this is, there's basically, to me, these three categories of sectors where you need to have some different approaches. And then the other component of the China shock, which we can see, is more on the consumer retail. And here I think the issues are a bit different, and I'm talking basically the small parcels, the Shein and Temu's, where we see very, very strong growth in parcel from China. I mean, are they destroying European industry? I think for most of what is being shipped there, European industry is almost not there anymore, but the issues are more about environmental impacts, about consumer safety and consumer protection, etc. And there we're a bit outside of the realm of trade policy, and it's more other considerations. But of course, the question arises of whether you want to deal with this with tariffs or other tools.
Good.
Yeah, so I first Isabelle had to explain to me what the shocks are. I'm not sure. I started to work on trade impacts on labor market. I stopped working on this, I think in 2012, 2014. So I don't know how the literature has evolved. But at the time, we were never looking at what happens when China is suddenly has a comparative advantage in skilled labor, in the high technology sectors. I think that's conceptually our Europe, we couldn't imagine this. Now, guess what? There will be an India 1 shock probably is already there. There will be an India 2 shock. India is probably producing currently already the highest number of university graduates. So what does that mean for our economies and for our societies? So I think we know what it means in terms of temporary adjustments in the labor market, what the distributional effects are. We know, I can imagine how that would work out, but what does it mean for our societies if now suddenly our skilled labor revenues go down further? And maybe low-skilled gains, I don't know. So yes, maybe we did not envisage this, but I can tell you that the BRICS world is watching closely how we are reacting, and what is currently our reaction to China 2 is going to be considered the future reaction to India 1 and 2.
So maybe I can just add something to the puzzle. So I think it's probably very true that trade economists are still have probably not taken all lessons from the first China shock. But I think the second one, I mean, if Europe is facing such a big shock, the challenges are going to be even worse due to the political economy concern, because here we are not talking only about local labor markets being heterogeneously exposed to this type of shocks, but also different member states being very much, heterogeneous in terms of their exposure. And I think it's a big challenge for the kind of cohesion of Europe. So, it's not really helping, but I think it's making the problem even worse, which probably means that we trade economists should work a bit more on these questions. So I see another, sorry, Bob wanted to.
Well, I was just going to say one last follow-up on this, because it's a great, important question. And my own perspective which again is only me, but I would take kind of a perspective from a trade agreement side and say that for the China shock, WTO has 166 members. There are very different circumstances. Some members would be able to deal with a surge in imports with perhaps some domestic policies to help their losers. Many members wouldn't. Apparently in the US, we didn't. And we had a lot of local labor market issues. And then what's the question from the WTO's perspective? I think from the WTO's perspective, it needs to be designed in a way that gives its member governments flexibility to respond in a rules-based way to these shocks. And the reason I think this is really relevant is the WTO does do that. So it has various renegotiation features, Article 28 and Article 19, that allow countries to, in an orderly way, say, these tariff bindings that I negotiated back in 1995 when the Uruguay round was finished, I had no idea that China was going to become the powerhouse that it did. If I'd known all of the import pressure, I would not have committed to these tariffs. I was committing to a market access level, a basic level of volume, but not necessarily to the tariffs. And so I have to have some way to get out of my commitments. And the GATT, from the very beginning, understood that. Back in 1947, there was always talk about we're going to make these commitments only last for 1 year. And after 1 year, we're going to revisit them because it was so novel at that point. And then those commitments became automatically renewed, but Article 28 allowed a country to revisit those commitments if it needed to on a permanent basis. So I think, for example, what the United States is doing now, if you thought of that as partly responding to the China shock, maybe late, but trying to respond to the blue collar or small rural town pain, there is a way for the U.S. to do that within the rules-based system, and that is to go through Article 28. Article 28 allows other countries to respond in kind to keep the balance, just like in the subsidies non-violation case. If the U.S. wants to withdraw access, that's fine, but other countries are going to get to withdraw a reciprocal amount. And to me, that kind of flexibility within the system that preserves a balance that was struck in the original negotiation is exactly the kind of rule that then allows every country to make its own decision in an appropriate way, which is, if we feel we need more protection, as long as we're not doing it partly because we're shifting the costs onto others, then we should be able to do that. And I think that's the way the rules should be able to work. They could be improved, but that's in theory how they're supposed to work. And so, I think the China shock, countries actually do have rights within the WTO to respond to those kind of things, and much better that they respond within the WTO than that they respond outside the rules when anything can happen.
So my question was actually exactly on that same theme. So you talked about Article 28. There's also, I understand, Article 19 and the escape clause. And so I was wondering, when has it been used? Is it something that can be used in a reasonable time frame? And what are the theoretical guidance? And also as a trade economist, so how would you use that? So it's import surges, so it's transitory, but how do we measure? What do we think is kind of reasonable? So a little bit of practice here, because I think that's for the European case, trade diversion. There's clearly an issue. So how do we think about that?
Yeah, so just we have 5 minutes left, so if you have questions, just manifest yourself so that we can take more questions. But
I'll be brief, but it's a great question, and there's been really interesting work by WTO legal scholars on this. So in the GATT, there was Article 19 that allowed for temporary raising my tariff if I have injury. And then in the WTO, there was negotiated an understanding on safeguards, the safeguards agreement, that basically put in new rules on safeguards. And Alan Sykes, who's a WTO law scholar, has written many articles saying why the legal rewriting of the safeguard rules in the WTO made it very, very difficult for countries to actually use the safeguard, whereas in the GATT days, it was much easier to use, and they were used much more often. And interestingly, this is kind of the way the world is. Why did the WTO have this agreement on safeguard measures? Basically because the U.S. was using quantitative restrictions. It was going outside the safeguard rules of the GATT and doing voluntary export restraints and managed trade. And so other countries said, look, we need to bring these into the rules-based system, because right now the U.S. is doing stuff out of the rules. And so the agreement on safeguard measures was written, but it was written in such a logically legal, inconsistent way that essentially every safeguard that was tried was challenged and defeated in the WTO courts, basically. So I think it's a great question. There a lot of people, I think, would agree, legal scholars and economists, that there are problems with the safeguard agreement. It needs to be reformed, and that's one of the things I think that is a real reform need.
Thank you. Marek Mośniewski from the Polish Economic Institute. So 3 years ago, we published a report on the friend-sharing issue, and I still feel that the issue that we are in a post-peace dividend era is the case that after invasion of Russia into Ukraine, we cannot speak about free trade in the same environment as before. And my question is following the Moritz question. So if we were to name China as a systemic existential threat for us, what trade tools should we use, and what costs should we be ready to bear to really make us safe or from this existential threat that can be in the long term? Thank you very much.
So who wants to respond? Maybe not the OECD, I don't know. Yeah, you can, okay.
He said if, right?
If, yeah, there's an if.
Well, we are seeing what is currently happening. With the space is being taken to rethink the system. I'm actually wondering now that I'm listening to Europe, whether everything that is happening in the US now is pretty gut consistent. One could argue for the WTO rules didn't work, subsidies have been operating for so long, so the non-violation actions that we should have taken a few years during this whole period and didn't take, now we take them all at once and we negotiate. There is a certain logic to this, or did I misunderstand you?
So I want to be on record as saying no. That's not what I'm saying. I understand what you're saying, but I think the big difference is what the Trump administration is doing is it is doing it outside the rules. It's not going to a dispute body and saying this, none of that, and it's doing it in a discriminatory way, and it's asking other countries to do discriminatory things for it. So these bilateral deals are very discriminatory, country by country, and in terms of the tariffs changes and the tariff changes that the U.S. is offering to these countries. So there's maybe the flavor, and so I would say, yes, the U.S., this didn't happen in a vacuum. The U.S. is responding to issues that are real, but I would say, personally, they're responding to it in a very unproductive way. There are WTO procedures that the U.S. could have used and could still use to do what it's trying to do.
No, we don't. We fully agree on
as
that.
long as we understand that.
You opened up an idea that I didn't have. That was not in my mind before. I think the reactions to the not using non-violation arguments is a bilateral reaction to something one country does. So. But that doesn't answer your question. What we are seeing is that some of these sectorial actions, like the sectorial solutions that are being thought, and you mentioned also that maybe we can work at the sectorial level. Initial discussions are taking place without the countries that are considered a threat But if we believe in the multilateral trading system, then we should at some stage find a way to bring everybody into that system again. And I still hope that that will be the case at some stage.
So we can take a very last question, quick one, and then we need to close.
Okay, so Juan Carlucho from the Bank of France. So if you could say some words on the appellate body crisis and how do you see that forward, because that's part also of the China-US controversy, as I understand, and also, as I understand, anti-dumping have been used kind of informally as a safeguard in practice in the US and in other places. So.
Okay, maybe very quickly.
I
guess it's a WTO-oriented question.
Yeah, I think the appellate body issue is a really interesting one, and one way to think about it, as Marion was saying, the U.S. kept losing on zeroing on the anti-dumping cases, and in the understanding of dispute, the agreement on disputes, understanding in the WTO language, it says the appellate body shall neither diminish nor add to legal obligations in the text. And so the U.S. has interpreted the interpretive role of the appellate body and the fact that it seems to be almost having a precedence-setting effect as basically adding to the legal obligation that the U.S. said we never signed on to an agreement that was not going to let us do zeroing. And they said that was a political decision, and the EU and the U.S. essentially agreed to disagree on this vague language. And now we've got an appellate body who's actually interpreting it against us. And the U.S. basically said, that's not what we signed on for. That's a violation of our sovereignty. And that's my understanding of kind of how we came to this impasse. There's really interesting legal work. Again, Alan Sykes has an interesting paper. So you might think, and I know that a number of legal scholars have said, what we really should do is go back to the GATT days. We should get rid, because in the GATT there was no appellate body. That's like the Supreme Court. There was no Supreme Court. It was just every panel made a decision. That dispute was settled, but it had no precedence on anything else. But then in the WTO, these appellate body decisions started to have precedence. So some view is just get rid of the appellate body. Alan Sykes has an interesting paper that's kind of a middle ground. He says, actually, if you think that the appellate body in the WTO is like the Supreme Court, it's actually not quite like the Supreme Court, because the Supreme Court can decide not to take a case. The appellate body has to take every case, and the Supreme Court uses its decision not to take a case smartly by saying the lower courts have not yet sorted this out to where we want to weigh in, so we're going to just wait. And whereas the appellate body does not have that. So his proposal is just keep the appellate body, but give them the right to say we're not taking this case. So it's kind of an interesting middle ground. Anyway.
Okay, sorry, we need to finish here. Thank you very much. Very interesting. Sorry if you had questions, but thank you.
We just got to go back.
Well, don't run away. We're almost at the end, but not quite there. Because after Isabelle, do you have a we want to say thank you to the people who have made this possible, and it's actually a long list. So you've seen hopefully a good movie, and now the credits come, and without these fantastic teams, this wouldn't have been possible. First of all, of course, our panel as well that finished this the conference. But let me start, and then maybe Isabelle takes over by saying thank you to the organizing, making the 4th Kiel-CEPR Geoeconomics Conference possible. First of all, I think the biggest thank you is to Sciences Po, who helped on all fronts to make this event possible, to Louis Bassi, who was here yesterday and open it up, and I think all of us will remember the hobbits now that we are here in Europe, the little hobbits in the Shire who don't want the evil world to come in. Émeric Henry, head of department, and obviously also Thierry and others who have helped. Our conference partners, the Institute for European Policy Making at Bocconi University. I see Daniel in the corner. Thanks so much, Daniel. And of course, special thanks to CPR, Bea, Tessa, and team, Richard for having the idea for it all at some point, Nadine Clark and Despina, of course, but we'll get back to Despina later. Sciences Po mentioned there's a lot of people in the building actually, which is a recurrent issue for the Sciences Po department, is access to the building, and it has worked fantastic. So Laetitia Valentin and the team of the Sciences Po 2028 Rue des Saint-Père team for their hands-on support, Edward Tour, Antoine Pommier, Maël Serré, Aurore Papaguet, and their colleagues for the technical help in the IT department, Anne Hauschild and Sarah Unterheim at the German Embassy, Sylvia Guibert, and the defense team of Alice Ruffo. So, now Isabelle takes over.
Okay, do you have my notes?
I have my notes, but they're identical.
Okay.
I think we're over there.
Yeah, over there. Okay, so now you have something. So I think it's the point when we are thinking.
We're thinking it's.
Yeah, the Kiel Institute, obviously. I should know. A lot of people at the Kiel Institute, the junior researchers that did a great job at keeping the time. The Sciences Po student, the red shirt students, and of course, the Kiel-CEPR organizing team, Despoinia, Elisabeth, the two Elisabeths, so Elisabeth Radke, Elisabeth Schröder, for managing everything from start to end, a lot of emails, amazing PDFs, everything has been organized in a complicated setting when everybody needed to walk from there to from here to there, and everything has been perfect. So thank you very much. I see Elisabeth. And
yes, maybe let's start with Elisabeth Schröder and Despina. Can you come down? We have a little thing for you, and we need to find Elisabeth. So can you come down, Elisabeth Despina, please? We've prepared a little organized little thing. Yeah, we'll find her.
That was great.
The international spirit of this conference, you also get a Halloween made by a chocolatier in Paris. Thank you so much. Please, come. Thanks. And so then we're waiting for Elisabeth Schröder to say a big thank you for the head of our Berlin office, our liaison person with CEPR, who has been the guiding force and orientation behind us. Where is she? Where is she? Do you want to do this? No, she's not here. She's still on duty. Okay, well. Okay. And then we give a big round of applause to Elisabeth Schröder in absentia, but we'll think of it. Thank you all for coming. Thanks.
So there is a post-conference drink, Rue des Canettes at Le Choupinou. I don't remember, Rue des Canettes. So it's at 6 p.m. and if you want to join.
Today it is Georges.
Is what?
Today it's a different location. Yeah.
Chez Georges. It was Wednesday. Okay, but it's still Rue des Canettes, no? Okay, anyway, chez Georges.
Should be in your documents. The idea is to you can come go to the hotel, slowly walk over, and there's going to be a drink for all of us.
That was fun.
Thank you again for coming.
Thank you.
Thank you to Monsieur Schularick and Madame Méjean.